All right, guys, I have a little bit more time tonight, so I'm going to record part 3 for you of my 8-part Pass Your Life Insurance Exam the First Time series. I'm not really going to give you the whole spiel. If you are starting on part 3, don't do that. Go to part 1 and start at part 1, and you can hear the whole spiel. So I'm going to go ahead and share my screen and get right into it. This video is going to be question 51 through 75. We do 25 questions per video, and it's 200 questions, hence the 8 parts. So let's get started with question 51. What would be an expense factor in an insurance program? Expense factor in an insurance program. This is coming from the insurance company's point of view. What's an expense to the insurance company? This one's going to be mortality costs. Of course, we know that the insurance company is going to have an expense whenever there is an insurable event, such as a death or a qualifying critical injury or chronic critical or terminal illness. So mortality costs. 52, what distinguishes a deferred annuity from an immediate annuity? And if you watched my hands just now, that would probably give you the answer, right? So this is going to be the time at which benefit payments start. We're going to go to the next question to learn the difference in the timing. How soon can the benefit payments begin with a deferred annuity? This is going to be a minimum of 12 months after the date of purchase. So if it's an immediate annuity, it's going to start anytime within 12 months after the date of purchase, hence the immediacy. Yeah. And then if it's a deferred annuity, it will start anytime after the 12 months after the date of purchase. So immediate versus deferred. One is now, one is being put off until later. 54, a unilateral contract is one in which unilateral. So uni meaning one, the answer is only one party, the insurer, meaning the company, makes any kind of legally enforceable promise. Now let's break that one down. So in an insurance contract, you have two parties, right? You've got the insurance company and you have, which is the insurer, and then you have the insured, which would be, you know, yourself or your spouse or your children, right? The insured and the insurer, the thing being insured, the thing doing the insuring. Now, only one of those parties is actually making a legally enforceable promise, which is what makes it unilateral. Now, why is it that only the insurer, the insurance company, is making a legally enforceable promise? Because you're thinking, well, don't you have to pay your premiums? Yes, but if you don't pay your premiums, nobody's going to bust down your door, right? Nobody is, forcing you to get an insurance policy. You're doing it of your own free will. So if you decide to stop paying your premiums, nobody can really do anything about it except for cancel your coverage. Now, if you are paying your premiums, your policy is in force, and you have some sort of insurable event, illness or death, and the company tries not to pay for reasons that are outside of any reasons that are stated in the contract itself for why it wouldn't pay, well, legally, that's not okay, right? Because the company made you a promise and you held up your end of the bargain. So legally, the company has to make good on their end as well. So only one side is legally bound to that contract. The systematic liquidation of a sum of money is provided by what? Systematic liquidation of a sum of money. And this is going to be an annuity, which is why we like annuities for retirement accounts, right? Because systematically it will liquidate, meaning it will provide us money over a period of time. And insurers' claim settlement practices are regulated by what? And this is going to be state insurance departments, which is why I said at the beginning of last video that you have to study your own state's Department of Insurance laws because they're not federally governed. They're governed by individual state insurance departments. All of the following are examples of a business continuation plan, except for which one? And this is going to be deferred compensation. I will run through as best I can the other three. So business continuation plan is basically what it sounds like. It is a plan in place to ensure that your business can continue to grow and flourish for as long as possible, even in the event that you are not around. So key person insurance would be if I own a company and I hired a CFO. If that CFO were to pass away, that's probably going to affect my business some way. So I would have a insurance policy on that key person to ensure that we at least had the funds to keep the company going until we were able to replace that person. Sorry, it's late again. That person that's very integral to my company. Cross purchase agreement would be if I own, let's say my brother and I are in business together, we own a company, 50-50 ownership, right? And we want to ensure the integrity of our company for years to come. So I would purchase a life insurance policy on him for the amount that his 50% would be valued at, so that I would have the ability to buy out his half in the event of his death. That way it doesn't go to the highest bidder who's going to come in and start, changing things around within the company. So that is a cross purchase agreement. Each owner would have a life insurance policy on the other owner to ensure that they had the money to buy out the other's half or third or whatever have you in the event that that owner passes away. Stock redemption plan sounds exactly like what it is. Over the course of a year, which premium payment mode is the most expensive? And this is going to be kind of like Costco. It's the best way for me to describe it. When you buy things in bulk, typically you'll get a reduction in the cost of that, right? So over the course of a year, your most expensive premium payment mode is going to be monthly because they're allowing you to break your payments down into smaller segments. If you were to do it annually, you can literally do this with your clients when you are licensed and you're doing applications. You can see on the illustrations, if you choose monthly, it'll give you a certain cost. And if you go to annually for the same exact plan and then divide that by 12, you will see that you'll get a little bit of a discount because you're purchasing that insurance basically like in bulk or paying in bulk. Which of the following types of information is not required for a life insurance application? And of course, because of non-discrimination laws, ethnicity is the answer to this one. What is a participating life insurance policy? I kind of went through this in the last video. I drew out a little diagram. When you have a participating policy and you are entitled to your share of divisible surplus, I drew out an entire diagram. So if you haven't seen part 2, go to part 2 for that. But the answer to this, what is a participating life insurance policy? That's going to be contract that allows the policy owner to receive a share of surplus in the form of policy dividends. Now, of course, you can look at B and C and you say, well, they're so similar. What's the difference? You as the policy owner of a mutual company, you would own a piece of that company. So you as the owner would be able to receive your share of surplus, not the beneficiary. The beneficiary does not own the policy. They don't pay the company. That's the difference. So owner receives share of divisible surplus, not beneficiary. Which of the following describes the increase in the probability of a loss due to an insured's dishonest tendencies? I would say this one's pretty easy. It's basically exactly what it sounds like. This is going to be a moral hazard, right? Dishonest tendencies, moral hazard. Which of the following is not a primary objective of insurance regulation? Not a primary objective of insurance regulation. And this is going to be D, interpret policy provisions. Insurance regulation has more to do with the laws and the states enforcing those laws than interpreting policy provisions. It's the same way that, let's say, USAA and AAA and Geico, their policies all have the same purpose, right, to insure you for your car or your home, whatever have you, but the policy provisions are going to be slightly different, the pricing slightly different in each of those companies. So the policies, or the companies themselves that are creating their policies with their own provisions will be the ones to interpret, but not the state, not the commissioner. It's not a primary objective of insurance regulation. That would be, protecting policy owners and insurance code enforcement. A life insurance policy that pays the face amount if the insured survives to a specific period of time is called what? Endowment insurance. So basically, you live to age 100 and we give you the face amount of your policy because that's basically what you paid us over the amount of years that you had it. So congrats on all your success. You made it to really, really old. So we're just going to give you the face amount so that you can enjoy the rest of your life and leave whatever's left to your family. Endowment insurance, they're endowing you. How are acts of war considered under a group life insurance policy? Now, we have to remember that group life policies are the ones that you have through your employer. So how is an act of war considered under your group insurance policy? This is going to be a policy exclusion. They are not covered under group life insurance policies. For those of you that are in the military or have been in the military, that's why you have your SGLI, right? Your $400,000 policy that's going to pay your family out if you pass away for any military reasons, like an act of war. What does the term illustration mean when used in the phrase life insurance policy illustration, according to the California Insurance Code? Of course, if you're in California, you can just disregard this one. This is going to be D, a presentation of policy features that includes, of course, non-guaranteed elements. So when you pull up an illustration, you say, how old are you? What's your name? How many years are we looking to cover you and how much coverage do we need? If it's something like, universal life or a whole life, it's going to go up and grow in cash. It'll illustrate projections, right? Non-guaranteed elements of what that policy could potentially do. So it's an illustration, presentation of policy features. Premiums are best described as what? And this one is, let me just double check, because this one always confuses me. Premiums are money paid by the insured to acquire a policy's benefits. Money paid by the insured to acquire a policy's benefits. Pretty straightforward. Mike has inherited his father's traditional IRA. As beneficiary, he will pay what taxes on any money withdrawn? If you have not seen part 2, I go a little bit further into detail on the difference between a traditional IRA and a Roth IRA in that video. So we're focusing in. Your key word or your key phrase here is traditional IRA. So if it's a traditional IRA, if he's withdrawing money, what taxes is he paying on the money that he's withdrawing? and this will be income taxes because it was a traditional IRA. If it said Roth IRA, it would say he would pay no taxes on any money withdrawn. If an insured's age on a life insurance policy has been misstated, what is the insurer's liability if the insured dies? So there's no penalty for this. They're just going to change the amount of coverage. So a prorated death benefit based on the amount of insurance the insured's premiums would have been if purchased at the correct age. They're just going to adjust it to what it would have been anyway. What is considered to be the definition of disability according to Social Security? And I went over this one in the last video as well. Unable to engage in any substantial gainful activity. Definition of disability according to Social Security, unable to engage in any substantial gainful activity. Restoring an insured to the same condition as before a loss is known as what? This is another one of those vocab terms that I said you guys have to know. You are not going to pass this if you do not understand what the principle of indemnity is, because the principle of indemnity is basically the definition of insurance. To restore an insured to the same condition as before the loss. Principle of indemnity. Which of the following is a type of insurance where an insurer transfers loss exposures from policies written for its insureds? Which of the following is a type of insurance where an insurer transfers loss exposures from policies written for its insureds? All right, so your answer is going to be reinsurance, and I usually do a little kind of demonstration for this one to help y'all better understand it. We have this kind of concept in real estate and mortgages as well. So basically what's going to happen is, let's say this is National Life Group, and National Life Group just wrote a $500,000 policy on me, right? So that loss exposure is going to be $500,000 because if something happens to me, they're on the hook for $500,000. Even if I die tomorrow after paying one premium, not a huge ROI, right? So what they're going to do, National Life Group is going to go to this company, and for reinsurance, they're going to sell that policy to this company because they just tied up $500,000. They're going to sell that $500,000 policy to this company to free up that $500,000 to go and write another $500,000 policy. So it's reinsurance. This is insuring the insurer, basically. If this company, right, that bought the policy from NLG, if this company only exists for the purpose of reinsurance, they're called a captive insurer. They don't see clients and write policies on clients themselves. They're a captive insurer. So that's how those two tie together. Karen is a producer who has obtained personal information about a client without having a legitimate reason to do so. Under the McCarran-Ferguson Act, what is the minimum penalty for this? Now, there should only be two, and I don't know if this is all across the board or if this is just California, but there's two questions in this specific 200 question thing that I have in front of you that pertain to fines and the amounts of fines. So this one, the McCarran-Ferguson Act violation, is going to be $10,000 fine. Minimum penalty, $10,000. So McCarran-Ferguson Act fine, $10,000. If you are, what is it, unintentionally, the other, okay. unwillfully committing an unfair method of competition, that's $5,000. And I do believe, yep, that's California insurance code. So if you're not in California, I don't know what it is for you guys, but if you are in California, if you're unwillfully committing an unfair method of competition, your fine's $5,000. If it's violating the McCarran-Ferguson Act, it's a $10,000 fine. So those are the two that you have to keep in mind. Pat owns a 20-pay life policy with a paid-up dividend option. Which of the following statements is true? Policy may be paid up early by using policy dividends, right? 20-pay life policy, paid up dividend option. Policy may be paid up early by using policy dividends. I don't know if anybody needs an explanation for that one, but I'll give you a small one. So if it's a 20-pay life policy with paid up dividend option, that just basically means that if it's a participating company and you're getting dividends, you can use those dividends to pay up your policy early. So let's say you got, $30 in dividends. Say I'm putting this $30 towards what I would owe. So help me to pay my policy off early, meaning like before the 20-pay for the 20 years. According to the California Insurance Code, what is insurance? We talked about this in the first video, I believe. Your 4 qualities of a contract. So according to the California Insurance Code, insurance is a contract because it meets those 4 contract requirements: competent parties, legal purpose, consideration, and I'm blanking on the last one. Competent parties, legal purpose, consideration, and offer and acceptance. So in insurance, you are putting in an application. The company comes back and says, yes, we will offer you $500,000, for $80 a month for 20 years. That's your offer. If you pay your $80, then that's your acceptance. So those are your 4 contract requirements. Insurance, therefore, is a contract. Most U.S. life insurance companies belong to what? My favorite tattletale is the Medical Information Bureau, right? And I say that jokingly, but basically, if you sit with a client and you're going through the application and they're not necessarily completely truthful, or maybe they just forgot about something, the Medical Information Bureau, as long as that thing that they didn't disclose, if it's on file somewhere with either previous life insurance company or via their health insurance company, you will get an email that says, hey, by the way, this client's medical records did show that they had this condition that was diagnosed on this date and they're taking this medicine for it and you didn't disclose. Can you tell us why? So most U.S. life insurance companies do belong to the MIB, or the Medical Information Bureau. All right, that one was a little bit quicker, so I hope that helped everybody. That was part 3. I will get part 4 out to you guys soon. And click the link below to study your vocab via the vocab Quizlet that I made so that you can pass the first time. Have a good night, everybody.